Hello, welcome to Owner's Equity Cash Dividends. My disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2020 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So we're going to be talking today about cash dividends. So the important thing to remember is that cash dividends are not mandatory. A company is not required to give a cash dividend to its shareholders. Generally, what's going to be happening behind the scenes is that in order to issue a dividend, and again, what is a dividend? It is basically a return. The company's made net income, the company has been profitable, and instead of reinvesting those funds back into the company, management and the board is deciding to give the shareholders a cash dividend. So it's a way of giving back to the shareholders. One of the things is that so before the cash dividend actually happens, the company has to make sure that they have enough money. As a CFO and a CEO, more than likely before a dividend is being issued, you're going to be going to the board of directors. You're going to show them we have more than enough cash to last us for a long time, and therefore we would like to pay a dividend to our shareholders. Many companies, if you're paying dividends to the shareholders, many investors like this. It can be very, very appealing. Again, it just depends on the company. A company like Amazon has never really paid dividends, whereas companies like Microsoft and Apple have paid dividends. It just depends on the particular company's situation. So from an accounting perspective, what we're going to be doing is we're going to be saying, so before we get involved as accountants, the CFO, CEO, and the board essentially approve the dividend. Once the dividend has been approved, there's going to be 3 different dates. And so the first date is the date of declaration. The date of declaration is when we come out to the market and we say, if you are a shareholder of record as of a certain date, we are going to be paying you a dividend of $2 per share or whatever the number might be. The next important date is the date of record, meaning that if you are a shareholder as of a certain date, then you'll be able to eligible for the dividend. The last one is the date of payment or distribution, and this is actually when the cash is actually being paid out. The 2 dates from an accounting perspective that we're most interested in are the date of declaration, which is when we're going to actually record the liability, and then it's going to be the date of payment or distribution when we're actually paying out the cash. Now, in general, the date of record, this is something for what we call the transfer agent. What is a transfer agent? The transfer agent is really the agency or the organization that keeps track of all the company's shareholders. So they know where all the shareholders are. So that's really the job of what we call the transfer agent. But the only things that we're really going to be concerned with from an accounting perspective is the date of declaration when we're going to go through and record the liability for the cash dividend that we're declaring, and then the date of the payment or the distribution when the cash is actually in fact paid out. So let's take a look at this example really quickly. And one of the things that I do want to kind of share with you is that, you might be saying, hey, Tchaikovsky, you lied to us. And, the way I would say this is I did not lie to you. Rather, I just kind of delayed telling you the full truth about dividends. If we go back to what we were doing earlier, what I would typically have you do when you would pay a dividend, and let's just say old way, X company pays a $50,000 dividend to its shareholders. So the way that this would happen is we would just do it, say, like on December 31st, I would debit dividends, and then I would credit cash. So this is the old way that we would do it. And this is really when we're going through initially and having you learn accounting. This is by far the easiest way to go through. However, that is not entirely accurate, because the real way that dividends work is that the company declares the dividend. It says if you're a shareholder as of a particular date, you're eligible for the dividend, and then it actually gives out the cash. So what we're going to do here is we're going to be looking at, the concept of, well, how does it really truly work? So right over here, going back to our example, is we've got over here, we've got ZZI has 2 million shares authorized and 100,000 shares issued and outstanding. On December 1st, the company declares a $2 per share cash dividends to shareholder of records. As of December 15th, 2018, the dividend will be paid on December 30th. The key thing here is that, so we've got this over here, we've got this amount. Let's go through it here and look at this. So kind of going back and talking about what we had gone through previously, is that what are the differences between authorized, issued, and outstanding? Well, I would have you refer to the previous video. So in this case right here, the authorized is just the amount that we're allowed to go through and issue up to. So we say we can issue up to 2 million shares. However, when it comes to dividends, I'm more concerned about how many shares are actually outstanding, meaning what amount of those 2 million shares are being held by someone outside of the company. So when it comes to paying dividends, the way that I'm going to be going through and determining the amount of the dividend that's going to be paid is I'm going to take the outstanding shares, which here it tells us we have 100,000 shares issued and outstanding. So I'm going to have 100,000 shares outstanding. And we're paying a $2 per share cash dividend. So the total amount that we're going to be paying to our shareholders is going to be this, where do we go? Oh, perfect. What we're going to be paying to our shareholders is going to be 100,000 times $2 per share, or $200,000. So this is the amount of cash that we're going to be paying to our shareholders. Remember, what is this again? This is, I'm taking my outstanding shares, meaning what shares are actually being held by individuals outside of the company. Okay, then I'm going to be multiplying that by the amount per share, which is, in this case, it's $2. So there's two dates that I'm most concerned with. It's the date of declaration, and then it is the date of payment. So here, for this example, I don't care about the date of record. That date of record right here is for the transfer agent. So the first thing I'm going to do right over here is I'm going to declare the dividend. The way I do this in terms of a journal entry is I'm going to debit on 12/1/18. I'm going to debit dividends for 200,000. And I'm going to credit not cash because I haven't paid it yet, but I'm going to be crediting dividends payable. And this is going to be to record declaration of the dividend. Okay, so I've declared the dividend. Okay, so the date of record on December 15th, I don't care. That is for the company's transfer agent. It's who is going to be eligible to actually receive it. I know that I'm paying out $200,000 in terms of who I pay it to. That's the job of the transfer agent. So right over here, and it's going to be over here. This is going to be paid on December 30th on 12/30/18. So what happens when I actually pay the dividend? Well, my cash is going to be going down. So I'm going to be crediting cash over here for $200,000. But at the same time, what account am I debiting? Well, once I declare it, I have this liability here called dividends payable. So now once I pay this out, I'm going to be debiting or reducing my liability and then crediting cash. So right over here, so this dividends payable is a holding account until we actually go through and pay the dividend. So when I look at this right over here, the net entry, right? I wasn't telling you a complete lie. Right over here is that if I were to combine these two entries together into one, it would be a debit to dividends and a credit to cash. But in reality, dividends don't really work that way. We have a date of declaration, we have a date of record, which is accountants we do not care about. And then lastly, we have our date of payment. So this is how dividends go through and work. If you don't know what a transfer agent is, or if I'm mentioning terminology that you don't know, if I go over here, so if I just type in transfer agent, it's like, wow, like right over here, transfer agent, one of the ones I've worked for, I think it's American Stock Transfer. So this is American Stock Transfer. They not only serve as a transfer agent, but they also do a lot more other things in terms of for shareholder elections, help you with corporate governance. There's a lot of different services they can provide to companies. So with that all being said, I want to thank you for watching this video today. Please do not forget to like and subscribe, and I look forward to seeing you on the next video. Have a great one.